The supertanker of the world economy is turning.
The amount of energy on the ground there around climate change and really delivering solutions, innovation, and that systemic change, you really felt it.
As that world decarbonises, what does that do to the economics of different industries, their ability to transition, and what role can we play in that?
Mining, commodities and resilience. Resilience, by the way, physical, social, economic, nature. It's not just worrying about rising sea levels in Miami. It's kind of everything, because this is the century of volatility.
Hello and welcome to a very special episode of Conversations on Climate. As the dust settles on arguably the most controversial of all COPs, we have climate activists and the fossil fuel industry both claiming victory. And guess what? Both are right. Much was won and lost amongst the late night compromises. We finally have wordings on the transitioning from fossil fuels, and there's a reinvigorated sense of inevitability to the energy transition. On the other hand, as we have not moved forward with the hard commitments that were needed, there's a general acceptance that 1.5 degrees may no longer be in reach. Now, what are the implications for global finance? Will COP change the financial system, permitting the flows of capital from where they are to where they're needed? In this panel session, organised by ESG Books, the Climate Bonds Initiative, and hosted by the Wheeler Institute here at London Business School, some of the industry's leading lights and this humble podcast hosts tackle these questions. It was an enlightening and impassioned discussion, and one that you won't want to miss.
So thank you for coming. Obviously, it couldn't be more timely to have a debrief from COP28. So thank you all for coming. Thank you for a fantastic panel, but thank you for an excellent audience. I looked through the registration list. It's a very interesting mix of industry, government, think tanks. So thank you all for coming. A quick welcome just on behalf of the Climate Bond Initiative, London Business School and ESG Book. I'm Daniel Clear, I'm the Chief Executive of ESG Book. We're a climate data, ESG data and technology company, 250 people in Boston, New York, London, Frankfurt, Tokyo, Singapore, and Delhi. So we're a partner to the financial industry and to the real economy, and our mission is to power financial markets for a sustainable future. I used to be at HSBC for about 10 years. I was running sustainable finance there. And I think I was sitting too often on panels complaining about the lack of data. So it was clear that I had to make the switch and move over to be a partner to the industry. COP obviously started in a fairly difficult environment. We had more than ever, I think, a concern on energy security. We had a political debate that is a lot more difficult in the US, but frankly also in this country. And we suddenly had money that isn't free anymore. Right? We suddenly had interest rates at 5-6%. And so some of the investments that made perfect economic sense 2 years ago were a lot more challenging. So the environment was much more demanding than it ever probably was. At the same time, I think the urgency was bigger than ever. We have the 7th year on record, which is the hottest year on record. So nobody can say this is a coincidence anymore. This is, I think, a series that nobody can deny. We have, I think most scientists believe, 4 to 5 years left before we hit the 1.5 degree increase target. That suddenly looks a lot more challenging to actually hit, while there's still sort of a little beacon of hope out there. And at the moment, frankly, we see very limited signs that we are decarbonizing at the rate that we need to. I mean, scientists do believe we need to decarbonize 40% in the decade, 8-9% per year. That's the amount that we achieved during the COVID lockdown, when the entire economy essentially was locked down. We all got excited, and I think, recovered most of that degrees fairly quickly. So clearly, not the easiest of environments, but at the same time, I think a real pressure to act. So I think the panelists will be much better placed to talk about this, but I took away a number of positives. I think one of the positives clearly is that there is a recognition that fossil fuels are at the center of this, that fossil fuels play a role, but there needs to be a transition. I think we all know that fossil fuels are responsible for 90% of greenhouse gas emissions in one way or the other, and are still responsible for 80% of the global energy production. So it was important that it became center stage of the discussion, more so than ever. There also was an agreement to triple renewables by 2030, so the production of output of renewables. That was important because if you believe the IEA scenarios, they say you need to get to 100% electricity production from renewables by the end of this decade, and therefore, obviously, the supply of renewable energy is incredibly important. And finally, there was a financial commitment to the Loss and Damage Fund, something that was long expected. So some really positive things came out, but also I think a number of concerns, and I will then pass over to the panel. I think one concern clearly is the change of a language from phase out to transition when it came to fossil fuels. We all read about it. The second for me is no clear targets for this decade, and we know how important this decade is. The third, I think there was real hope that we would finally land on an agreement on a carbon price, and we didn't. And then I leave you with a little fun fact. Obviously, we now have a $700 million loss and damage fund, which is a real success. But 700 million is the amount of annual salary of the top 5 soccer players in the world. 3 of them are playing in Saudi now, just as a little coincidence. So I think huge achievements, but also I think true concerns as we're heading into a new year, a COP that is hosted in Baku, which will also be interesting and demanding. But we have a fantastic group of experts here. We'll have a panel until 10 o'clock with time for a few questions, and then we have at least half an hour after that for networking Q&A, where I think all the panelists will be for more private conversations. So enjoy. Let's make this as interactive as possible. And I'll hand over to my colleague Isabel, who leads climate research at ESG Book, and she will be the moderator of today's session. So thank you, welcome back to school, and thank you for coming.
Thank you.
I thought I was running.
Thank you, Daniel. So let's dive into COP28 and see what went down there and what it means for finance at large. We'll have a good panel here. Some of you went to COP, so you'll be able to share some of the experiences on the ground. As Daniel said, the panel will be about 45 minutes and we'll have some questions in the end. So if anything comes up, please do save your question and we'll make sure to reserve some time. With that, let me introduce you to today's panel. Next to me sits Sean Kidney. He is the CEO of the Climate Bond Initiative. You probably know CBI as they are co-organizing this event, but for those of you who don't, it's an international NGO that works to mobilize capital to address climate change. And they're a key player in the standardization guidelines to create a larger and better investable green asset class, particularly fixed income green bonds. Sean went to COP, and when we did a prep call yesterday morning, he had balloons in the background of his Zoom call. So he was in a very good mood. We'll have to learn more about that. Next to him sits Catherine de Koning Lopez. She is the Global Head of Responsible Investment at HSBC Asset Management, and her team sits within the investment department, and she oversees ESG products, research, ESG integration, stewardship, as well as deep climate research. She has a long track record in responsible investing. Prior to HSBC, she was at Invesco as Global Head of ESG, and prior to that at Columbia Threadneedle Investments. She is a scientist by background, but also might feel a little at home here because she did her MBA at LBS. Next to her sits Andy. Andy is the Global Head of Sustainable Investment at Schroders, and he spent most of his career in sustainable investing as well. Before joining Schroders, he was at Goldman Sachs, where he led a research team of GS Sustain in London. And you might know him from, he is the mastermind behind SustainX. It's a tool that Schroders developed to assess the cost of companies' externalities. And it's quite interesting. We might come back to that later. And then in the end is Chris Caldwell. He's also an alumni of this school. He is a climate tech investor and the CEO of United Renewables. He has developed many projects here in UK and wider at large. And you might see some of the cameras. It's because you are all in a podcast live. Be sure to check that out. It's called Conversations on Climate. He normally is the host, so I'm now just for one time taking over his seat. But be sure to check that out. Welcome to the panel. Before going into the conversation on COP and what it means, I want to do a quick temperature check on COP and a stock take to keep it in the same vocabulary. I want to play a good backup. Just 2 words, binary. You have to pick overall. What is your assessment on COP? Sean, I will start with you. Good COP or bad COP?
2 words.
Yes.
2 weeks of meetings with 100,000 people. Jesus, that's hard.
If you had to pick. If you had to pick.
The supertanker of the world economy is turning.
I will say it's the pragmatic COP.
4 out of 10?
I'd say it's bad COP, but that mightn't be a bad thing because it could catalyze change.
Okay, so it's overarchingly good, but it's, I would say, in the middle. That's the assessment.
I don't have a compliance team, so I can say what I feel like.
Yes, absolutely. So it's not overarching positive. We have to learn more about that. Sean, can I ask you to give your assessment? What were your expectations going into this COP, also based on COP 27, and what was it for you when you were on the ground vis-a-vis your expectations?
This microphone's not working, right?
No, it is. You have to use that one. This one's for the video.
I've never had much expectation of the government process as a practical, real process. You know, after all, the United Nations is a voluntary collection of nations, some of which are small as Togo or Vanuatu, where I was born, which has only got 350,000 people, some of which are rather large. What counts in the world economy is what the major economies do. So China, US, Europe, India, Japan, whatever they do is what everyone else will do. So practically, that's where we play. However, the COP is a gathering of people working for change. It's incredibly useful. And the symbolism and signalling from the nature of the global discussions is useful. We know what politics is. Politics is often about symbolism and signalling. You know, there's a fantastic Doonesbury cartoon about how Bill Clinton used to have a director of symbolism in the White House. I don't think it was actually quite true, but it was a really convincing story. So the COP is actually really good for symbolism, and we saw some good symbols coming out of the COP. But when I make my comment about the world's supertanker of an economy is shifting, I'm referring to a wide range of things with the COP as a kind of way that's being illustrated rather than necessarily the driver. So let me just leave you with one panel. I was on a panel, I did 25 panels in COP. One particular panel I was on, at the end of the row was one of the world's biggest banks. The guy from the bank was saying their job now is to help their clients to transition. It wasn't HSBC. To help their clients transition. Yes, I thought. Next to me was the Deputy Assistant Undersecretary of US Treasury, and also co-chair of the G20 Sustainable Finance Working Group with the PBOC, who's the other co-chair who we'd met with a couple of days before, who was talking about the IRA and what's happening in the US. And, you know, it's pretty damn exciting, the kind of investments that are going into solutions here and the electrification of the US, which, you know, 80% of the IRA is about clean electrification, fundamentally. And on this side, next to me, was the international representative of the Ministry of Economy, Trade and Industry in Japan, the Super Ministry, who was talking about their green transformation program, which is amazing. Again, it's 80% about electrification, clean electrification. And I actually stopped at one point and I said, hang on everyone in the audience, just savor this moment. Because you've got two of the world's largest economies, and we know other economies are doing the same, like the EU, talking about the extent to which they're now pushing, driving, subsidising, regulating for change. You've got one of the world's largest banks, which at least represents a few of the world's largest banks, now talking about how all their clients... This is an amazing moment. You'll look back in 10 years and you will think, whoa, that was an inflection point in the global economy. And that's what I think this COP will be. So I'm not talking necessarily about the particular agreements, although there are wins there. That sums it up for me.
That's good. And then Catherine, I'm curious what you saw.
Yeah. Well, this was my second COP. So previously I'd been to COP 26 in Glasgow, and I think similar to Sean, what struck me with this one really was the sheer scale. I mean, it was 80,000 people there, right? It was absolutely enormous. And you walk in, and it's the security style expo center, and you've got these big tankers where you've got climate finance, energy transition, you've got innovation and technology hub, you've got all these big screens saying, partners to COP. HSBC was a partner, and it's just amazing the amount of energy on the ground there around climate change and really delivering solutions, innovation, and that systemic change. You really felt it. And I think that was really catalyzed in my mind at COP26, where you were bringing in more of those industry finance discussions. It really felt very central to the discussion now. So in the space of 2 years, you really had this just systemic change. And for me, it's a train that's not stopping.
So let's go deeper into the systemic change. As Daniel said, a key topic this year was fossil fuels and what should be the future for fossil fuels, given some countries are still very dependent on it for their economic growth, especially emerging markets. Other companies are reliant on it as a key driver of their own economy, but obviously many countries want to transition away from it or even phase it out. We had almost 100 countries stating they want to phase out. However, there's still major players in the world that cannot live with that. Andy, I'm curious, what do you take away from the eventual agreement that was made on fossil fuels, and how do you see it as an investor impacting your own practice?
So I think it was interesting. I mean, as sort of Sean mentioned, the COP, I didn't go to COP. Partly, I think the really critical thing here is what happens between the big grand statements rather than necessarily the big grand statements in and of themselves. I think I look at the fossil fuel discussion and the amount of attention that focused on, and rightly, it is a critical point, but 3/4 of the world's carbon emissions, or greenhouse gas emissions, come from fossil fuel use. The idea that we were going to get to limiting temperature rises to 1.5 or 2 degrees without essentially phasing out fossil fuels over a reasonably ambitious time frame doesn't make sense. It was already implicit. Similar thing with, as Sean mentioned, around renewables. The idea that we were going to make the transition that has already been committed to without increasing use of renewables, again, it's implicit in it. And you're adding a bit more specificity. You're sort of going from big grand statements to a little bit more specificity around that. But it was already a requirement, and the debates about the timing and the wording and what precise word we used, etc., I think to me were more concerning about what that indicated in terms of people's realisation. It's fairly obvious, but sort of willingness to translate high-level statements into tangible action. So from our point of view, the way we look at fossil fuels across Schroders is here is an industry that's right in the crosshairs for all of those reasons of the transition to a low-carbon economy. I would agree with Catherine. I think the train is moving. I don't think it's moving anywhere near fast enough, but it is moving. We need to see more policy action. If you look at the level of policy action that we've seen over the last 12 months, globally, sort of the pace has roughly halved relative to the last couple of years. So the actual policies that will deliver the transition have dropped off in the last 12 months or so at a global level. On the other hand, we've seen as many companies have set intentions to have decarbonisation or net zero targets during the course of 2023 as existed with those targets at the start of 2023. So you do have, it depends how you look at it, glass half full, glass half empty, but there is a transition there. It is therefore imperative that as an investor, we look at fossil fuel investment through the lens of how will this industry be impacted by the probable transition to a low carbon economy over some time frame, whether it's quick enough to get us to net zero by 2050 or not, time will tell. And we look at it through that lens, and it's effectively the lens of, as that world decarbonises, what does that do to the economics of different industries, their ability to transition, and what role can we play in that exercise, primarily through encouraging transition. we would start from the view that oil and gas companies in particular have asset lives that are relatively short, compared to coal mining at least, where they are able to transition if they put their back into it, and if their plans are sufficiently ambitious, they do have a path to a sustainable business model, and our role as investors is to encourage and support that transition. Coal is a little bit different. The asset lives in coal are very long, the cash generation is relatively low, and that's an industry where, frankly, we can't see a path for that industry to a sustainable business model, and we don't invest in coal mining companies across the firm. But oil and gas is about transition, and I think that's really the critical point. Whilst there is lots to not like in the word transition is actually a really important word in terms of how we think about this. I know there were a lot of headlines around the oil and gas industry being at the COP. They had to be at COP. They're the root of the problem. They had to be there. They had to be at the table. They didn't have to be dictating the terms, and I don't think they did. But for us, this is a exercise in understanding how that transition will impact the industry.
Thank you. And could you, just curious on that point, could you give a few examples? You say the fossil fuel industry has to transition. Is it then indeed to shift to renewables, or is it broader just changing their business model?
It doesn't have to be. It could be shrinking their business model in a disciplined way. It doesn't have to be about moving to renewables. The good thing about financial markets is that it doesn't necessarily need the large oil companies themselves to build up renewable companies within their own business. The question all comes down to, is that particular company the best operator and owner and developer of those assets, or are they better off returning capital to shareholders who are then able to deploy that elsewhere? And that, who I think for the most part want to. So it's not as straightforward as saying everyone has to transition. I think if you look at oil companies, certainly that we've engaged with, have been examples of companies where there's sort of an adjacency, a logical thing of offshore wind farms that are close to existing oil fields. Again, there's a logical reason why they would be the best operator of those things. Building a solar farm in the Sahara, not so obvious. Support the first, didn't support the second.
Thank you. And then I want to ask Chris, because he is the renewables expert here in the house. Curious from an industry perspective, what do you take away from this COP? And maybe you can also address some of the points that Andy is mentioning about the ability of current fossil fuel companies to actually operate renewable companies, or whether that should be sort of totally different companies.
Okay, fair enough. So big takeaway from taking the second point first from the fossil fuel industries is the transition is now inevitable. I think we can all probably accept that. So whether you think that this COP was a big victory for the fossil fuel industry or a big victory for the renewables industry, in both cases you're right. The two things can both be correct in parallel. But one thing that is really clear at the end of this COP is the word unprecedented is massively overused, but we genuinely do have an unprecedented level of unity. When that first draft came out of the agreement, and there was no phase down, phase out transition wording in there, the movement that pushed back against that was really unprecedented. And then you saw that letter, the leaked letter from OPEC, and if you'll excuse me, I'll read. So in their own words, the pressure against fossil fuels is reaching a tipping point which puts their future at risk. Like, the fossil fuel industry is fighting so hard because they know that they're fighting a losing battle. Like, this letter, and together with a couple of other kind of missteps that were made along the way, that's discussion with Mary Robinson, which turned around very badly, and via various other leaks in the BBC. It seems to have been pushing things towards that tipping point that was mentioned in this very letter. So what's the implication for the kind of the fossil fuel industry and fossil fuel businesses? Well, they're going to keep on pushing the CCS. CCS is important. We do need to be doing CCS, but it isn't going to be making the massive difference that they hope it will. Even if 100% of all of the CCS projects that are currently in planning gets built by 2030, that only accounts for 1% of total emissions from last year. So it's important. It needs to be done, but it isn't going to be the silver bullet that they're looking for. So the changes that are going to come will be, rather than from the supply side, because they will keep on supplying as long as there's demand, they'll come from the demand side. And as we see progressively more problems from climate change, we're going to see a shrinking of that demand. So over time, there's, back to your question on what are they going to do and what the diversification will look like. Well, it won't be buying Cristiano Ronaldo another Ferrari. What needs to be done is diversification into universities, into education, into industry. Like the massive wealth of capital that's there right now can be used to be transforming an economy. And part of that will be renewables, and it should be renewables. But it can't be the be all and the end all. Like you've got very significant economies there now that are fully capable of being transformed as long as the capital is put in the right way. As far as renewables and whether a kind of COP has made a massive difference to renewables, COP has never made a massive difference to renewables. Like it's one of those. In theory, it should, but in reality, it doesn't. We've been kind of driving around it. It's very good at making big statements, but it's poor at implementation and it's poor at funding. So we've been driving around it for years. So for all we need from the developed world, all we need is to get more renewables built. We need strong regulation. We need a clear direction of travel, and we need the planning system to be optimized for renewables. Like European Union makes some big steps in that direction. That's great. In the developed world, we need blended finance, and again, that's not something that we've had a lot of from COP. We need a supportive system. I think actually the biggest miss from last year wasn't COP itself; it was the Paris summit on new global financing, where the Bridgetown Initiative was on the table and it wasn't adopted. If we get something like the Bridgetown Initiative, then that will really make the difference for blended finance. Would love to talk about the Bridgetown Initiative, but I'm conscious of time. If anyone wants to talk to me about it, please do. But that would be another kind of hours-long conversation. But it's a very a good set of revolutionary steps to transform the energy system, so to transform the financial system to make it fair. So.
I want to then pick up your point on the challenge of funding.
Yeah.
Right. So I'm curious, how do you, Catherine, see that as an asset manager? How do you invest in the energy transition?
Gosh, well, that's a big question. I mean, we have, I would say, there's sort of three main aspects to our approach to, let's call it climate, energy transition overall, but actually responsible investment. But climate obviously being the single biggest priority within that. It really is the topic that all clients want to hear about. It's the topic, obviously, as an HSBC group, we've made significant announcements. I'll talk about some of them. I think just maybe picking up on the educational point and the partnership point. At COP, we announced that we would support this what we call CASI, the Capacity Building Alliance for Sustainable Investments, where we're going to aim to educate 100,000 financiers in emerging markets on sustainable investment. So that sort of education systemic change is really important. But in terms of the three main things for responsible investment, really it's research. So thinking about research data, how are we actually incorporating these environmental carbon emissions, very technical concepts actually into our investment process. Then it's stewardship. So how do we engage with companies? We have targets around that. We've got very short-term, longer-term targets, specifically on topics like thermal coal, energy, power. And I think, some of the announcements at COP or the innovation on display from companies, they're doing that in part because investors are supporting that, right? And saying we support that journey from companies wanting to drive change. And then the third thing is products, right? So we are building new solutions, new products around carbon, climate change, transition, green bonds. It's all there in the suite of solutions from us, but also obviously the wider market. And you look at some of the Morningstar data, climate funds is the single biggest growth in terms of the, sustainability products on the market. So I think, we're doing a lot on the energy and transition. Obviously more to do, but as I say, it's a train that's not stopping and there's a lot being done already.
Thank you. And then Sean, on the product side, your organization has been really at the forefront of establishing a credible green bond market. What do you see in the future, in the near future, and maybe in the end of the decade, 2030, in terms of what also Chris mentioned, blended finance versus the more established green bond space? Like, what are you seeing in terms of innovation to make this financing happening for example, renewables deployment?
Well, renewable is only a small part of what we have to do. A big, important part, but just want to stress, we're talking about a whole economic transition here. The whole of the economy in every sector. I made one speech in COP where I said that we're going to have $1 trillion of green sukuk alone, and we're going to have $40 trillion of thematic finance going forward when we know we're really making progress. Now, what do I mean by that? Well, what we're talking about is just matching what investors, asset owners in particular, want to do now and are concerned about and what needs to happen. Asset owners, generally globally, now believe that the future's been decided. Thanks to the Biden Climate Summit, 2030 commitments, thanks to the policy initiatives in the USA, Europe, Japan and China, that kind of debate's gone. It's all about now the speed of transition, how quickly it's going to, and how you're going to pick winners and losers. How do you ride the wave, or do you get swamped by the wave? Those kinds of issues. So that's what I'm seeing. And in that context, the thematic issuance is a way of quickly connecting with folks who are doing something. The scale of thematic issuance is a signaling device. One bond won't do it. 4 green bonds, and now you've got a story kind of idea. That's what I hear from my Swedish investor friends who are probably the most advanced thinking about all of this. For that reason, this is going to grow, because everyone now wants to signal. And in fact, in Europe and in the UK and a few other countries like Japan and the Philippines, you have to signal because transition plans are becoming mandatory. So every listed company has now got to put, this is kind of like, Jesus, it's not going to be a race to the bottom, I can tell you. It's going to be a race to the top. And that also is going to provide great tools for you, two of you, to take to your clients and say, here's how you can tell who's doing something. We're going to get a lot of transition bonds. People in some of the discussions in Europe don't like the concept of transition bonds because they were originally around gas and we used to shoot them down. But we're now saying that actually in terms of a company that is a crap now and going to be good, that we need a lot of these companies like steel and cement companies, then this is a way of recognition them. We need appropriate reference benchmarks, trajectories to be able to assess them. A lot of us are working on that. We are, SBTI is and others. So this is going to be a big growth area. So when you think about what the thematic market's going to be, what we're really talking about is how we make visible capital with purpose, or rather, capital that understands that sustainable returns are now dependent on a sustainable planet. And that's all the large investors. Small investors can still stock pick their way out of problems, but universal owners, anyone who's got a $500 billion fund, there's a lot of them in the world now, actually can't stock pick their way out of the problems. They need the economy to rise, and they're more and more exposed to the global economy. So they're invested in the whole idea of how do we ensure that we get returns across the economy and that our economies don't collapse, because that's going to lead to wholesale portfolio destruction. That's why I see this as a growth area. There'll be multiple instruments, fragmentation of instruments. Our job is to keep it all broadly consistent. I often talk about gelato. Started off with vanilla or plain, now we're getting green gelato, transition gelato, blue gelato, but it's all gelato. It's capital with purpose in the context of 1.5 degrees. And for that, it's going to be exciting. Now, the only question is, going back to what the investor thinking is, can we do this fast enough? And that is still certainly uncertain.
As a quick thought, because I think the thing that bridges fundamental growth, if you like, or where capital gets deployed and how policies come through and investment returns, is valuation and price. And I think it is, if you look at, if 5 years ago, if you'd invested in the oil sector or if you'd invested in renewables, today you'd have made roughly the same amount of money. You've been on a roller coaster since then. So 5 years ago, renewables companies were trading on a similar valuation to oil and gas companies. They rose to a 500% premium in terms of valuation, and they're back down again to trading roughly on a similar valuation. So you've been on a bit of a roller coaster over that period of time. And when we think about the investment returns that are available, as in how is this going to attract capital in a meaningful way, and you've seen money coming out of climate funds certainly in public markets over the last 6 to 12 months, in some cases, that the valuation question, as in how does markets' expectations of how growth will play out in different industries and how that will translate into profit growth relate to or disconnect from the actual growth that we think we're going to see? And in some ways, I think that growth expectations, some of the the narrative around this has tempered, certainly over the last 12 months, and that has been reflected in valuations. Actually, oddly enough, puts us in a somewhat easier position in terms of actually delivering returns growth from an investment return point of view than perhaps we might have been at a point where they were trading at a 500% premium as they were 12, 18 months ago.
So yeah, it relates to some extent to what you're referring to, Sean, is that an individual investor can perhaps stock pick, but as a universal owner, you will have exposure. I'm curious, Andy, to pick up on your point as well. How do you see this also play out, the lower asset valuation for oil and gas, for example? How do you see that play out as it comes to the discussion between divesting and engaging with some of these entities?
So I think it goes back to a similar point, really, in terms of divestment versus engagement. So, and I'll put coal slightly off the table, because I think it's difficult to see how that transitions. Oil and gas companies, certainly in our assessment, still have the opportunity to transition. It's not going to be easy. This isn't a kind of marginal exercise in financing a few wind farms. This is about a wholesale reimagining of their business model, but there is a path there. Again, going back to the investment and the return question, if you look back over the last 5 years, if you had bought the companies that did the best in terms of the top quintile of emission reducers within their sector, so the best performers in terms of reducing their emissions intensity over that 5-year period relative to the peers within the sector, relative to the companies that did the worst, you would have generated about 4% annual returns. The market is rewarding companies that can transition, and that rewarding is not just because they got more expensive, it's because their earnings grew. They were sort of fundamentally better companies to have owned, and that came through in terms of the profitability. I would also argue that as an investor, we are active participants in that role. There's this tendency to think of fund managers as stock pickers. You kind of come in some morning and the sort of genius picks which stocks are going to go up, which ones are going to go down, and then hopes for the best. The reality is that if that was ever true, it's certainly not true now. A large part of how we can add value is through the voice that we can lend and the pressure that we can apply at times to companies to encourage them to transition. We have a very much a transition-focused climate strategy. We have a significant number of engagements with companies on climate change. I can tell you that the companies that we've engaged with have been twice as likely to set an emissions target as companies we didn't engage with. They've cut their emissions twice as quickly, and they've outperformed by about 3% a year since we began that programme. So there isn't a dichotomy, there's not a tension inherent between transition and returns. Actually, transition is probably the best way of unlocking returns from both an investment and from a societal point of view.
And I think this is a really critical point, that what we're at now is a situation where investors, in particular, are starting to understand the idea of creating the future, of driving activity that will lead to sustainable returns, not just try and shuffle deck chairs, the Titanics, stock pick the way through it. And we're seeing that in a lot of cases. I now have a lot of asset owners willing to go to the treasuries of governments around the world and talk about what they'd like them to do to shift their economies to become more investable going forward. And of course, some talking about withdrawing from sovereign purchasing and so on, as a parallel to this corporate engagement that Schroders is doing. This is a really important, it's part of the pivot change. And the reason why the pivot change will accelerate, in my view, or the super tanker shift, is just because of this. It'll be investors driving this globally across mid-sized countries, and even in Japan, which is a pretty large economy. You know, at the PRI in-person conference a couple of months ago, we had the president of Nippon Life make a speech that was like a Greenpeace campaigning speech. Like, it was amazing. Now, this is not an organisation that's renowned for being particularly active. And then he was followed by the head of Daiichi Life at another forum I was in. And then the Prime Minister of Japan made out a speech. The Prime Minister of Japan's a mixed kettle. He's made some bad speeches, but this time the scriptwriters allowed him or gave him the script, and the script was actually fantastic. It's all on record, it's all on video. I can tell you, we can pin them down. And I'm thinking, this is a sea change. This is a sea change equivalent to one that I felt early this year in Singapore when I heard the head of the Monetary Authority of Singapore, Ravi Menon, make a speech that was also like a Greenpeace activist. And when you start thinking about how this is happening, the odd countries around the world, not the UK, unfortunately, hey, you realise, wow, things really are changing. We're moving now to a race to the top on climate policy, and that will overwhelm any kind of uncertainty from the UAE about fossil fuels, I can tell you.
I want to quickly go to Catherine, because obviously you, in your asset management practice, deal with a lot of engagement with companies as well. Could you elaborate on that? And also particularly what some of the panelists have mentioned, the difference between emerging markets and developing countries. How do you, when you do your engagement, deal with that?
Yeah, no, great point. So, and I completely echo what both Sean and Andy said. So, and I'll say from our perspective, one of the things we have put down is really every energy power company needs to have a transition plan. That's sort of our baseline. Now there can be differences between developed markets and emerging markets in the nature of that transition plan, the level of ambition, the timelines, the amount of disclosure that different companies are willing or allowed to issue, right? But certainly that sort of concept of having a transition plan at minimum really is the expectation. And so specifically we look at the ambition. So what is the level of ambition in terms of timelines, in terms of capital investment, in terms of emissions targets, in terms of strategy. And so we are talking to companies, both in emerging markets, developed markets, about this. And for our investment teams, both on equities, fixed income, and RI, the way we work together is we create effectively an assessment approach where we're looking at how credible are those transition plans? And that's really what we're working on at the moment. And it's not easy, right? And policy is changing, expectations are changing, local requirements are changing constantly. But what we're really looking for when we talk to companies is that best efforts, trying to improve that stated ambition. And I think, we have seen, similar to Andy, really very impressive results from companies in emerging markets on this. And, there is an argument now with new requirements on better disclosure that actually emerging markets from an opportunity perspective is possibly one of the better opportunity areas, because they've just been underappreciated because of a lack of disclosure, and with some of the new requirements, they will have to disclose, and so they will be perhaps more attractive from, say, indices, from the different rating agencies will be able to assess these companies that they haven't been able to before, because there's obviously, from our perspective, we are able to have those kind of conversations when we own a security. We're able to incorporate that into our analysis. And the wider market in terms of ratings, et cetera, will also be able to do that going forward, which I think is really exciting for emerging markets specifically.
Yeah, and if I could just kind of elaborate on that. We have a tendency to overcomplicate. It is known that the transition is going to be complicated and expensive. But in reality, it isn't. We know what we need to do. We know we need to stop funding fossil fuels, and we know that we need to start to get funding into the Global South and to funding to the transition generally, but really focusing on the Global South. Katrine mentioned ratings agencies there. A really good example that came out of COP is Colombia. Colombia signed up for the Fossil Fuel Non-Proliferation Treaty, which said that they wanted to keep their coal in the ground. It is a very important part of the economy. They said they wanted to keep it in the ground. And what did we do? As rating agencies, we downgraded them. Yeah, absolutely absurd. Absolutely absurd. We need to be giving help to countries. Now, this isn't the first time it happened. Like Ecuador, going back 10 years ago, a similar thing happened where they said they wanted to keep $3.6 billion from the Green Climate Fund, and we all know how much was in the Green Climate Fund at the time, nothing. And that was to keep 1.6 billion barrels of oil under the ground. And that wasn't even under the ground. That was under the Yasumi rainforest. So an important thing to try and do, but because there was no money there to do it, the drillers went in and it was all extracted. So this is the context that we're working in. We have the money. Just to give another fun fact on that $700 million for that we raised for loss and damage. In the hour that we've been in here, we will have given more money as humanity, as subsidies to the fossil fuel industry than that $700 million. We give $7 trillion a year in subsidies to the fossil fuel industry. In this 1 hour, we'll have given less than that 700 million loss and damage fund. If that doesn't blow your mind, I don't know what will. We have the money to be able to make this happen, and we have the money to be able to make this transition happen. It's just in the wrong places.
And quick question, how do you see that in your own business? Because you're more operating here in the UK and in the region here. Interest rates obviously will affect you.
Mm-hmm.
How do you see today versus 2030?
Well, okay. I don't want to get in any way political here, but it is very difficult to be trying to build in the UK, and it is mainly a planning issue rather than anything else. So we have diversified out beyond the UK. We do quite a lot in Scotland, Ireland, mainland Europe, and into island nations generally. The larger stuff you can do, and it's quite easy to find finance. Easy. It was easier a couple of years ago. Interest rates have gone up, but as long as you're doing boring onshore winds or boring onshore solar, you're okay. When it comes down to going into emerging markets, developing economies, that's when blended finance is really important, and that's when things get far more difficult, and that's where we need something like the Bridgetown Initiative to try and help us kind of track down through those issues. Like, one of the problems you deal with is the delta of the cost of capital. So you need to be doing things in a much more efficient way, much cheaper way. You need to worry about hurricane risk, like trying to get insurance is a complete nightmare in large parts of the world, and it's parts of the world which desperately need renewables and desperately need resilience. But so I'll leave it at that.
Yeah, that brings us also to adaptation finance and some of those thorny issues that we've seen past this COP. I want to go beyond fossil fuels. Carbon markets was also a big topic at this COP. Curious what the two asset managers in this room think about that, carbon markets, and did we move the needle there to some extent, even though we don't have a new framework, as was the ambition. We have a lot of criticism. I would say in 2023 was a year of a lot of scandals as well. But what is your perspective on it long term?
I may have missed an important announcement, but I don't think the needle particularly moved.
No.
But no, to be more serious, if you look at, we think this is really important. If you look at the amount of capital that's currently being put towards voluntary carbon markets and nature-based solutions, is a couple of % of climate financing. It could be about a 30% share of the emission reductions that are needed to get us to Paris goals. There's a massive disconnect between those two, and it is fundamentally a relatively cost-efficient way of delivering emission reductions. Clearly, it's a market that faces real challenges in terms of credibility, in terms, frankly, of integrity of many of those offsets. However, COP26 back in Glasgow laid out the beginnings of a framework that could have moved that forward, and I think it was a real missed opportunity to provide some clarity and structure as to how that framework and how that market can evolve going forward, that could really start to try and attract the capital that is going to be needed to grow a nature-based solutions, in particular market, certainly the carbon offset market more broadly. If you look at companies around the world, again, McKinsey have done this data, you're looking at about a 10 to 15 times increase in demand for carbon offsets, just looking at the commitments that different companies have made. This isn't to claim that offsets are the solution to the problem. They're not. They are a way of accelerating the solution to a problem, in our assessment. And I think there is a missed opportunity. So I don't think it has particularly helped move us forward. I think basically it's been punted to next year's conference. That's a real shame.
Yeah. What about you, Catherine? Is it good that we took a break from making any more sort of goals around the carbon market and kind of let it play out and then see what the actual fundamental problems are around credibility so that we can pick it up later?
Well, what I will say, and Sean, be interested, but in my perspective, this was a topic in pretty much every conversation that I was in at COP. And I think it just illustrates how complex that topic is. And so, more thinking is clearly needed, is what I'd say. And on that note, we have joined what's called a climate Global Climate Finance Center think tank based in the UAE to really do more thinking around all these topics. And so I think that's what I witnessed personally there. A lot of conversation, but also what I would say is the importance of nature. So the importance of thinking about biodiversity, being thoughtful around that topic. Is really important in that context. So more to come, I would say.
Yeah. And if I could just add one more point, I don't think it's a massive shock that we didn't get an agreement, a global agreement on carbon. It's for the Americans and the Europeans to agree on anything. It rarely happens. Like even 500 years of accountancy practice, we still haven't managed to get common standards. So on something as complicated as this, it'll be hard to get. But one really interesting point that we didn't see any particular pushback against the European cross-border carbon mechanism. And that, I think, is really important. It would be a natural it should be a natural red rag to a bull. But because there was no pushback, at least that gives the perception that it's priced in, that this will be a part of the international trade system going forward.
So CBAM is part of what asset valuation today should be for companies that want to operate in Europe.
Yeah, it will be, but I think it'll also be a standard that's set, and blocks will form, and carbon trading blocks, and they'll figure out how to interact with each other. And hopefully, this is the beginning of another one of these positive tipping points, where you'll see strong climate action occurring as a result. Of almost a passive acceptance that this is the way the world is. Yeah.
CBAM has been an incredibly successful policy in the European Union because, just one simple key feature, the European Union said if you collect the carbon taxes in your country, we won't collect them. And then set up a country observer panel inviting other countries to join. Japan, Korea and Australia have all joined. They're all developing carbon schemes to interact with Europe. This is fantastic. China is looking at doing this, but has difficulty because the emissions trading scheme is a bit undeveloped. They've got a long way to go yet. But they're acutely aware of this idea. It's been very, very influential. Effectively, it's creating the idea of a green trade window, which is something we've been pushing for some time. These are the really substantial issues around carbon going forward. In a sense, it's not even the actual agreement, it's the signalling that's involved. The CBAM is not going to be material for a while yet. Well, it's going to start next year. The CO2 markets, it's $2 billion, right? This is not a big market. So in a sense, it's a rounding error. My concern with the carbon markets is how do we get money to forest countries to make sure they don't cut down their forests. That's it. That's a very focused market. We've been saying very clearly we're going to need a carbon price for residual emissions as we transition, but it cannot be first mile. You can't keep polluting and buy carbon credits. And this is a discussion that's being normalised now in the carbon world, but we're not quite there yet. But at that point, for the residual emissions, as you reduce your emissions, that money needs to go to high priority areas. We need to open it up to forest protection. We are not going to get the Amazon or Gabon or Congo especially to do much unless they're getting checks signed. And so we've got to find a way to make it work. But I'm just going to throw two other issues at you, because there's a lot of issues that came out of COP, and I meant economy-wide. In gas, yes, we've had this discussion about gas, but remember that one really important win was the methane pledge. 75% reductions by 2030. Yes, that's what we've got to do. Now, the oil companies that signed up think they're going to still be able to keep exploiting gas while they're doing it. Okay, but they've now admitted leakage. They've admitted it's a problem, which allows us to get consensus around rethinking the impact of gas. We generally say that gas is not much better than coal globally because of the nature of persistent and consistent leakage. To get 75% reductions by 2030 is going to be very hard. We have the satellite monitoring, we can track the buggers. So we now need to push the issue around gas. We're going to be looking at abatement as long as you don't extend the life of a plant or have new plants. This is going to be a big discussion. It looks like a loss. I actually think it's a win at this COP. And then the last one on food, resilience, heat and so on. I was in a lot of panels where we talked about food in the context of climate impacts, resilience and heat. We're going to see significant mortality. It's already started as a result of really severe heat happening around the world. Just understand, climate change is happening very, very fast, and it's a J curve, right? It's a classic J curve. We're just in the elbow, and it's just going to go like this over the next few years. Every year is going to be the hottest year on record, most likely, although it's volatile, you can't be sure. We have to prepare. Now, that discussion has started. We haven't done it, but the discussion has started. In emerging markets now, people are starting to think, oh, God, that was really bad last year. What have we got to do again? Now, I will be judging future COPs not on the basis of the mitigation agenda, which I think is essentially in principle being one. It's now a how-to. I'm going to be discussing on the extent to which we are properly addressing resilience measures that will allow us to save lives in a very short-term way.
Maybe I can... That efficiency point specifically, I want to pick up on, because that was definitely something that that was in a lot of the conversations I was in at COP, and a lot of the companies, particularly using information and technology to drive efficiency, and that sort of point on, methane leakage, right? And really knowing where those gaps are, and knowing where. In the case of the big technology companies, we're announcing new platforms and tools that were driving, say, the aviation sector to increase efficiency. That was also, interestingly, driving individual consumer behavior. And I think that is the big change that we really also need to affect. And it was starting that conversation around how do we use information technology to really drive efficiency and driving changed behaviors in every individual. And so I think that's a really important point.
I want to turn the mic to the room and see if anyone has questions already. Can be continuing on the topic of resilience and adaptation. I see a hand there.
Hi, Erin Withy, HSBC. Thank you so much for your time. My question's around CCUS. So in some conversations we've been having with clients prior to COP, particularly the kind of oil and gas super majors, the view is very much that the world will still be using oil and gas in 2050, but it will be decarbonised through the use of carbon capture. And my question is, for the whole panel, do you see carbon capture as maybe a distraction from other ways to get to transition? Is it frustrating the process? What's your take on that?
We need to do everything we can to get emissions down. We don't have the luxury of saying don't do one thing because it's too expensive. Try everything. That includes CCS and some forms of CCUS. Because of the temporal issues involved, it's complicated, it's very heterogeneous. But there's no doubt we've got to do it. My own view is that in the 2030s, we are going to massively scale up direct air capture as part of the range of system. Although I will also say that tropical forest regrowth is going to be way more important, which is why we've got to pay people to regrow forests in Sumatra, make it more profitable to regrow forest than to plant palm oil trees and so on. And land use change. The big opportunity for us with sequestration is soil. Changing soil practices. No more maize, more quinoa. Quinoa is very good for sequestration, by the way, if you're interested. So if you eat that, I hate it myself, but if you, just think you're doing something really good for the climate, and avoid corn at all costs in terms of it's very bad for the soil, etc. But CCS is part of the mix. In terms of enhanced oil recovery, so it's mad. But look at what the IRA has done in the US, where the IRA has had massive tax credits for CCS, not for enhanced oil recovery. Occidental has now bought one of the largest carbon direct air capture companies for $1 billion and has got the largest direct air capture scheme in Texas, which is fantastic. That's a path for oil companies finally doing something useful. I think we can see a lot of that as part of the mix. Is it a main part of the game? There are so many other things we've got to do. Is it important? Yes, it's a bit like nuclear. I'm not a big fan of nuclear. The IEA says at the most it can be 8% of global energy generation by 2050. Not exactly a silver bullet, isn't it? But it's low carbon. I always say close fossil fuels everywhere before you close nuclear. It's mad to do it the other way around. Absolutely lunatic. I say this in Japan and so on, as much as I don't want it next to me. And some nuclear that's coming through is interesting. I saw a desktop fusion reactor in UAE. a desktop. They're installing a 10 kilowatt version in Taiwan. These sort of things are going to be part of the solution. Try everything. The key thing is the decarbonisation measurement. So when it comes down to CCUS and so on, what we've got to be tough on is that we're capturing all the appropriate data and we're keeping them honest about it. But if they can make it work, hey, who am I going to argue?
Yeah, and I think that's the main point, if they can make it work, and that's a massive, massive if. Yep. We've had this isn't new technology. We've been trying to do this for 30 years, and for some bizarre reason, the cost curve has been going the other way around. Normally the cost curve gets bent down. This cost curve has been going up. So will it be a part of the solution? Yes, but will it be, I think the words you used were, will it allow for the continuation of fossil fuel extraction? No, it won't. Like it can play a part on a much scaled down decarbonisation of that, but it won't allow business as usual, not even close to it.
I was going to say, echo all of those points, but I think also thinking about where does this get deployed, primarily in difficult to abate industries or industries that are more challenging to find an alternative technology. Yes, I can see it playing a bigger role, but for the majority of industries, certainly when you think about power generation, you think about the big sources of emissions, the economics aren't there, and the economics seem unlikely to improve down a sort of an economies curve, because the technology is fundamentally not susceptible to rapid cost reduction as you get sort of learning economies and as the industry grows. It's not that kind of technology. So the idea that the economics dramatically improve relative to areas like renewables where the costs are already pretty compelling relative to fossil fuel generation doesn't seem to quite make sense at the moment. But yes, and it'll have a role, it's just not the role.
Not yet.
Maybe just one. At COP, actually, the hard-to-abate industries formed a coalition called the Industrial Transitions Accelerator, the aluminium sector, the steel sector, the cement sector. I think in recognition, one, that we need technology to move faster, but also we need to be more joined up on all these initiatives. So I think there's a lot of hope for that accelerator, and that word accelerator was in a lot of initiatives. Yep. Sort of really recognizing, we've got 6 years to 2030.
Mm-hmm. It's around the corner. Any other questions from the room? Yes. And maybe also address who your question is for.
Andrew Ross from Global Garden. There's a question for Sean. The focus of COP28 was intergovernmental. What was the role played by cities and the mega growth of carbon emissions by cities and the control that cities themselves have over planning policy? Do you have an idea of how municipal green bonds were being supported?
I have a view too, but you can start.
Can I suggest we take a few questions, then I'll come to Andrews, if that's okay?
Yes.
Hi there, it's Barbara Oldani from Nature Finance. So Catherine mentioned the word nature once and biodiversity. I have looked at the agenda of the COP28. I wasn't there, but there were quite a few venues with emphasis on biodiversity credits. What's the view of all the panelists about such a market, the development of such a market or in general? I'm curious to know.
Let's take one more.
Hi, thank you very much for taking my question. I'm an alum of London's Business School and used to work in research, equity and credit. And I have a question for Catherine and Andy. Catherine, you mentioned specifically that your research team's working on assessing transition plans by various companies. You said it's difficult. So just want to give one example. Just I think yesterday, Norilsk Nickel, which is a Russian global mining company, they just published their first transition report. It's very bulky, it looks very serious, but I think big question, it's one of the worst polluters, right? We know that. The question is just how authentic this kind of reports and how you go about finding out what actually happens on the ground. Is it realistic to assess this type of reports?
Should we take also your question? Yeah.
Hi there. My question will be towards Catherine and Andy, more from kind of global asset manager perspective. And Dennis from Janssen, by the way. Yeah, I was just mainly thinking from the transitional finance perspective, given like if we look at GSS plus Universe at the moment, like we have green bonds, we have like sustainability bonds, all the other labeled products, and transition bonds are actually like picking up like the momentum. But the investable universe is not mature yet to make like a sole product focusing on SLBs, for example. And for example, most of the SLBs, they sit within like global bond products, et cetera, et cetera, et cetera. What's your take on the future of this kind of product direction, and when are we gonna see like dedicated SLB bond fund or like transition bond fund focusing on like hard-coded type of targets, for example? Thank you.
I'm looking at the room if there's another question.
Hi, Nav Raunier, Sustainability Advisor to Tata. I think really good questions that are being posed here. How are we going to achieve that with post-GFC legislation that we have on banks, and even for likes of Schroders as well? You've now got capital management rules coming in, similar to the investment banks. Risk appetite. We need the banks to open up, the financial sector needs to open up risk appetite. And when I'm speaking to bankers, one of the observations that I'm seeing is, well, senior manager framework, senior manager regime that's gone in. If I mismark the price in a green bond, if I go and trade a, let's say, carbon credit, VCM, again, mismarking of the price, legal conduct risk, the list goes on. How do we open up the risk appetite? Because if we really have a climate crisis, and we're serious about sorting it out, doesn't government and central bank need to play a part here in giving flexibility to financial sector, to finance, especially hard to abate sector?
Thank you. I think we have about 3 questions for Catherine and Andy. So it's about the risk appetite vis-a-vis the challenge that we're facing with climate crisis. We have the transition bond question, the gentleman here, and then we have the authenticity of transition plans, and also the nature credit question. So I'm putting it to you all together, but
you can go.
How you want to take it?
I want to pick the city.
Right. In no particular order. So transition plans, the way you fully agree, you can stick out a big long document or a short document that's got some target for 2030, 2050. And I think, yeah, look, bluntly, a few companies have done this as a way of saying, get off our backs, we've got a plan, we've got a target, leave us alone for a bit. The way we would look at it is slightly different. So it's very difficult at this stage, given the number of transition plans that have been laid out over the last 12 or 18 months, to be able to really gauge the degree to which companies are delivering on those plans. But what we can do is we can look at, are the elements in place within those plans that should give us more confidence over whether or not companies will deliver them. We can look at who within the organisation is responsible, how are incentives aligned. We can look at, is the company incorporating climate into its capital allocation process? Are there the right organisational indicators that should give us more confidence that that plan will be delivered, rather than it just simply being a stated target for some point in the future? And that's something which we've worked very hard to try to work out, what are those indicators and how do we best apply them to understanding the likelihood of future targets being met. It's not a perfect science, because the targets that companies were setting 5 years ago, if we're being honest, probably didn't have the same level of focus or scrutiny as targets that are being set today, but we can at least bring some structure to it. And ultimately, over time, we can then also incorporate, are you actually delivering on them, which is ultimately the point of this exercise. I would say as well that when we talk about targets, they're important, but they're not the point in a way. What we're really trying to understand is, to what extent is this company going to decarbonise, if I just focus on companies, to what extent, how do I expect the emissions of this company to change in the future? Targets are a useful component of that, but they're not the answer to that question. Companies may be doing a lot of things without targets that would lead us to expect emissions to decline in the future more quickly than companies which have targets which aren't doing any of those things. So it's a component, you can bring more structure to it, it's not perfect, but I think you can at least be thoughtful about how you try and assess companies, and then more importantly, you can engage with companies to try and ensure they're taking action. Just on the last one, the regulation point, I don't really recognise that problem in Schroders in terms of us feeling unable to develop, and our Schroders, for clarity, so we're about $1 trillion asset manager. We operate globally. We are an asset manager. We don't use our own balance sheet in a material way. A very small proportion of that $1 trillion is our own balance sheet. Our job effectively is to develop investment strategies for our clients that meet our clients' needs. I will say that our clients' needs are themselves changing. The point of our industry fundamentally is to connect capital to areas of social and economic need that can generate an economic return for investors in those funds. There are few areas of greater economic need than climate change or the environmental challenge more broadly, and I think it's becoming clear that there are also opportunities for economic return if you do that in a thoughtful way. So I don't see any dichotomy, and certainly we're not running into problems within Schroders around a need to not be innovative, not be creative in terms of how we're approaching that. And then just finally, in terms of the transition bond piece, I think it is a really interesting area. I think I don't know, it'd be interesting your thoughts, Sean, in terms of whether the conversation around some of the evolutions that we're seeing in Asia in particular, thinking about some of the MAS work around phasing out coal-fired power stations and some of the credits that might be associated with that, I think is an interesting area in terms of that transition bond piece. It's a relatively small part of the market, as you say, currently. I think it will grow, but I think it's just, I'd look at it through a slightly different lens. Rather than just focusing on the asset class, it's the fundamental point. Transition is going to be the key. We've thought about climate investing as being investing in low carbon assets or investing in renewable energy or something. Fundamentally, climate investing is a verb rather than a descriptive noun at a point in time. The focus is on how do carbon emissions change over time rather than simply are carbon emissions low today for a particular portfolio or a particular asset. We haven't been very good at that as an industry. We tend to focus on snapshots rather than transitions or rather than sort of time series type views. I think we're getting better. Transition bonds will be a part of how we as an industry can support, facilitate and frankly benefit from the transition journey. But it's still relatively new in that journey.
Yeah, lots of questions there, but I do actually, just on the cities question, I wanted to pick up on that because I was impressed actually when I was listening in. The UAE launched something called CHAMP, so the collaborative multi-action partnership, basically to bring cities into the the conversation and recognizing actually there are different ways to skin the cat, but around 90% of emissions coming from big cities, and that concept of circular economy, really trying to build in supply chains into taking it sort of down a level from policy to municipalities and then obviously to the various industry actors supporting the cities in that transition and circular economy toolkit. And actually you had some of the countries debating what does good look like there in terms of circular economy and kind of trying to accelerate things through those kind of new ways of thinking. So it was definitely a big discussion at COP. Maybe, I can pick up on the other topics too, but maybe just for Sean on that one.
I want to keep Sean for the end because he's going to give us the closing remarks. So I'm gonna keep Sean's thoughts also on your question for that. I think it is time to close off the panel. There's a lot to say, but I want to close this off with one question for next year COP. If you would design the agenda and you had to put one point on the agenda, what would it be? I'm starting with you, Sean.
Everything was on the agenda, but more on resilience. Resilience.
Just transition. So we haven't really talked about that today, but actually in the big announcement on transitioning from fossil fuels, two of the big mentions were on that it needs to be just, it needs to be equitable, it needs to take into account people and economies. And to be honest, that's how you make it sustainable, right? Having an incentive for individuals to transition. So the just transition.
I've already said nature-based solutions, so I'll say climate financing. And I think really unlocking dollars rather than talk.
Well, I don't have a short answer, so I'm afraid I'm going to take a couple of minutes of this. So apologies. What I would suggest is we need to be fixing the COP structure. So fundamentally, like, the decision-making structure is a bit of a shambles. We know it will be late. Nobody bothers booking their flights back on the day that it's supposed to end. We know that everything will get half done. We know that consensus, like 100%, is no way to be running any sort of legislative body. Fun fact, the unanimity point was brought in on the request of OPEC in 1994. So, like, unsurprisingly, it's been used by OPEC to be pushing these forward. So it isn't, it's so kind of large and unwielding, it's not really fit for purpose for the implementation side of the business that it needs to do. So what I would suggest is, the point in the agenda is creating a new zone, a red zone, a kind of an implementation zone, a kind of like a cracked unit of like 1,000 individual representatives with no fossil fuel lobby, no lobbyists of any sort allowed in there, with the pure and simple task of going and executing and just making sure that Paris is signed up to, that Paris is delivered upon. The blue zone continues as it is, green zone continues as it is, but we just got one kind of a core unit of an implementation team put in there. That should move us a lot closer to getting the type of delivered progress that's needed from a COP.
That's good. We have resilience, we have just transition, we have climate finance, and then we have a total reform of COP to make it all happen. That's very good. Please join me in thanking this panel. And then I want to give you the floor, Sean.
I'm just going to stay here, if that's all right, amongst my friends. You heard a lot about the COP. I want to posit the COP within 3 big wins that we have globally. The first win to really be aware of, because this is how we change things, is state action. We are not going to get the pace and speed of change without strong state action in every area you can think of to create a sustainable future for our children. We have already state action. The only reason Chris Cornwall is making money is because Germany in 2001 introduced the feed-in tariff and got large-scale offtake agreements that started driving down the cost, the learning rate. Germany and then China, through billions and billions and billions, I think it's about like $100 billion, and essentially subsidies declining over time, which drove the scale of production, which drove the learning rate and reduced cost. That's state action. We're seeing exactly the same thing play out in electric vehicles, thanks to China's massive subsidies for electric vehicles over the last 20 years. The cost is dropping like a stone, and game over for petrol-based vehicles, which, by the way, is also game over for the oil industry. So bear that in mind. That's future projection stuff. And we're now beginning to see it. The child of renewable energy, green hydrogen, will be what we see changing in the next few years. We expect to see trillions of dollars of investments in green hydrogen and ammonia to replace fertiliser, to replace shipping fuels, to replace feedstocks in the chemical industry, in the steel industry, etc. State action is driving that. State action is underway with the IRA, the GX plan in Japan, the Chinese initiatives, etc. We've seen some wins at COP, which are milestones towards that. The multilateral development banks collection. Ajay Banga got all the CEOs of UNDPs together for a photo opportunity. Talk about great symbolism, finally collaborating. But also lots of announcement of risk mitigation to pick up what we do on banks that Ravi mentioned earlier. It's going to be a blended finance festival for the next few years. We need to do a lot more to make that work. We did see significant increases in allocation to capital, which will be risk capital, like the UAE's $30 billion climate finance fund. So the UAE done a few good things here. Like the increased capitalisation of the Green Climate Fund, an extra $12 billion allocated to it, and so on. These are important announcements. And at a DFI level, by the way, picking up this theme of risk blending, I had a meeting with BNDES and the Inter-American Development Bank about the Amazonian collaboration amongst 17 development finance institutions to reduce the cost of capital, to get capital flow to the Amazon. The solution to the Amazon deforestation is not to focus on deforestation. It's to focus on wealth creation in Amazonian cities that does not include deforestation within that plan, and that's what we're working on in that region. So you sort of see how the COP is coming together around this. The other win that we've had in the past few years that's important to note in the context is amongst regulators. You know, the NGFS has changed the terms of intellectual debate. Risk is now central. For HSBC, for Schroders, it's pretty hard to avoid this risk issue when your regulators are saying, have you addressed this risk issue? That has been incredibly important. And it's playing out in lots of ways. We're now playing out in requirements of transition plans, benchmarks. In a way, what Ian ends up doing will be, to a large degree, driven by how the regulators start assessing what to do around transition plan. Damn good thing. In emerging markets, we have incentives associated with regulators. The People's Bank of China requires all banks in their bond portfolio to make 5% of them green. It's a nice, crude, simple indicator to grow the market. There are multiple incentives like that coming across the Banco Central of Brazil, the Reserve Bank of India, and so on. And the risk of default is now a central issue. Taxonomies, area we work in a lot, are essentially a shopping list of things that are at lower risk of default going forward. That's all it is. Crude as that, but very powerful. As Christine Lagarde says, she wants to link their initiatives around supporting green to the taxonomy, and that's the case in every single country. The third area that I want to say is a win is the increasing deepness of collaboration between government, finance, and corporates. You know, we don't make this transition by just forcing corporates to change, because they often can't do it in a financially viable way unless there is enabling regulation or demand aggregation, or like the Germans did in 2001, subsidies or feed-in tariffs or whatever it might be. We need to bring all these things together. That collaboration is palpable in a few countries around the world, in Singapore, in Denmark, where Denmark's plans for offshore wind has incorporated the oil and gas industry, which is going to be closed down, who are going to have a shift, they're getting opportunities to build wind farms, the unions who've now got a just transition plan, and ambition. They are planning to build enough offshore wind to power 25% of Europe's electricity needs on a good day. That is just extraordinary. And building 2 large islands to go green hydrogen and so on. But that's collaboration that's made that work. And we see the same thing in Japan, in Australia, and sort of emerging in the US, but it's a long way to go. That's the future to go forward. Next, we will need to see some tough guidance. The gas question is now about tough guidance. The CCUS question, tough guidance. We haven't really done enough of that. So when we talk about transitions, that's what we're talking about now. We need to embrace transition, but say, but, it's got to be in line with the IEA Net Zero plan or 1.5 degree trajectory and so on. And that's what we're doing in steel and chemicals and shipping already, and certainly will be the feature of the gas story the coming year. Mining, commodities, and resilience. Resilience, by the way, physical, social, economic, nature. It's not just worrying about rising sea levels in Miami. It's kind of everything, because this is the century of volatility. It's too late now. World's going to go like this. And some of the stuff that's going to hit our societies is going to be extreme, tough, and ugly. Unless we can find a way to, A, bounce back quickly in those societies and also support each other, we are doomed. You know, when it comes to earthquake resilience, academic studies have shown that the extent to which a community operates together is strong, is a predictor of at least 40% of mortality. If you know your neighbours, you are more likely to survive a crisis, and that applies at a global level as well. If we know our countries, if we work with each other, if we have joint institutions that are beefed up to be able to respond quickly, whether it be World Health Organization or FAO, we have more chance as a global community to recover and to survive and to reduce mortality. That's going to be the big theme of the next years. Things like blended finance all become subsets of that broader collaboration argument. But what I want to leave you with is this thought of this sea change that's happening. It's an amazing thing that's happened in the last 10 years, exemplified by these two friends next to me here, which is this idea, this incredible game-changing idea that is still having a lot of trouble taking root in Texas, which is that sustainable returns depend on a sustainable planet. That they're not opposed, they are the same thing. That capital with purpose is necessary now to ensure we can pay Isabel's pension when she retires. Actually, this is the same story, they're not different stories. And that is the real revolution we're witnessing. We saw it popping up at COP, we saw it popping up all the time. We saw it popping up in the green bond market in the last few years, but above all, it's popping up in the comments we've heard from Catherine and Ian. Watch this space. This is the real excitement. And above all, go out and make it happen. Because, of course, you've got a special job. We're lucky here. We have the privilege that we can do something to make this change happen. Most people don't. We are unbelievably privileged. But with privilege comes responsibility to act. And in the context of climate change, to act fast. Go out and make it happen. Good luck.